Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Selling your business, I mean, it's not just another transaction, is it? Especially for founders, maybe in that lower middle market range. It's often, the result of years, maybe even decades, of just incredible effort. Sacrifice, too.
Yeah, and it gets tied up with your identity. It's a huge decision, not just financial, but deeply emotional.
Exactly. So today we're doing a deep dive into that whole journey, the M&A process for your business exit. We've got this great roadmap you shared, and our mission here is to pull out those key insights, those aha moments, really focusing on owners in the lower middle market.
Mm-hmm. Cut through the complexity a bit.
Yeah, cut through the jargon, highlight maybe some surprising things, and just help you understand what really matters. So you can go into your own exit feeling, knowledgeable and confident.
Sounds good.
Our main source for this is an M&A guide, Seller's Roadmap to Successful Exit. It really lays out the steps pretty clearly, but it can feel overwhelming, right?
Oh, absolutely. You're still running the business day to day.
Totally. Leading the team, serving customers.
Yeah.
And now you've got this massive, complex other project. So think of this deep dive as maybe a shortcut, helping you get informed so you can, lead the deal, not just react to whatever happens.
Right. And it's interesting, the whole idea of selling often starts internally, doesn't it? With those quiet questions.
Like what?
Well, am I really ready to step away from this thing I built? Or maybe a bit of fear, what if buyers dig in and find flaws I haven't even thought about?
Yeah, that sounds familiar. Totally normal thoughts, I imagine.
Completely. And that actually highlights why the very first step is so critical, getting the right deal team together.
Okay, the deal team. So having advocates in your corner right from the start, why is this team just so essential? Especially, like you said, for those lower middle market founders who are often doing, everything.
It's really less about just finding someone to buy it and more about preparation. Proper preparation, protecting the value you've built, and frankly, avoiding some really costly mistakes.
Mm-hmm.
For those founders who are deeply involved everywhere, this team becomes their shield, really, and their guide through what's probably pretty unfamiliar territory.
So who's on this essential team?
Well, your core players are typically a sell-side M&A advisor. They run the whole process, position the company, negotiate terms. Then you absolutely need an M&A lawyer, someone who lives and breathes transactions, to handle the structure, the legal risks.
Right, not just your regular business lawyer.
Exactly. And a sharp CPA or maybe a fractional CFO, someone who can really present and defend your financials under scrutiny. And, beyond that, thinking about tax advisors, wealth planners early on, that can be really smart too.
That makes sense. Bringing in that specialized firepower. But choosing them, that feels like a big decision in itself. How do you pick wisely? It's a lot of trust, time, money.
It is. And you've got to vet them thoroughly. Don't just, look at a fancy website. Ask for references. Specifically, talk to other founders who've sold similar-sized businesses.
Good point. Similar size, similar industry, maybe?
Yeah, ideally. And here's something that's often missed, make sure you actually click with them, This is intense, it's emotional, trust and good communication, that cultural fit, it can be just as vital as the resume.
Okay, so the click factor matters.
It really does. And this early prep work, getting that team on board early, it's not just about making things look good. It builds confidence. It builds leverage.
How so? Leverage?
Well, because you can fix potential issues before a buyer finds them. You can get answers ready for the questions they'll ask. Get your documents organized. That speeds up due diligence later. It's like, imagine going into a big negotiation already knowing all the tricky spots. That's what preparation gives you.
Okay, I see. Preparation equals power.
Not much, yeah.
All right, so we've got our A team assembled. Now we hit that massive question, probably the first one on every owner's mind. What's my business really worth?
Yeah.
It's tempting to look at, giant public companies or those tech unicorns.
Right, and that's a common trap. The source guide points this out clearly. Those big guys often get higher multiples because of things like super predictable recurring revenue, maybe proprietary tech, or just massive scale. Your business, especially in the lower middle market, likely plays by different rules.
So what are those rules for the lower middle market? How is value seen differently?
Well, first, the guide defines lower middle market as typically, say, $2 million to $15 million in EBITDA. That's your earnings before interest, taxes, depreciation, amortization, basically a core profitability measure.
Okay, $2 to $15 million EBITDA.
And companies in this range, they generally trade at lower valuation multiples, often in the, let's say, 4x to 8x range. It varies by industry, growth, risk, of course.
4 to 8 times EBITDA. That's a key number range to keep in mind.
It is. And for these businesses, value is really built on steady cash flow, solid operations, and clear potential for growth. It's less about those flashy metrics you might see in bigger deals.
Got it. More about the fundamentals.
Exactly. Which brings us to a really critical aha moment for a lot of founders. The headline offer is almost never your take-home cash.
Okay. This is huge. So you get an offer for, let's say, $30 million. You're saying that's not what ends up in your bank account. Break that down. Why the gap?
Absolutely. The guide uses a great example, that $30 million offer. Realistically, it might only translate to something like $21.3 million in your pocket after everything.
Wow, that's a big difference. What causes that drop?
Several things chip away at it. First, taxes. Depending on how the deal's structured and your situation, taxes can take a bite of maybe 20% to 40%.
Ouch. Okay.
Second, most deals are cash-free, debt-free. Means any company debt on the books, that gets paid off at closing right out of the purchase price proceeds.
Right. Makes sense.
Third, transaction costs. Your advisors, lawyers, accountants, their fees, often success-based, come out of the proceeds too.
Okay.
And finally, a big one for founders.
Escrow.
Escrows. Okay, I've heard the term, but what exactly are they in this context, and why are they such a big deal? Yeah, they can be significant. You'll usually see two main types. There's a general escrow. This is typically 5% to 15% of the purchase price.
5 to 15%. Okay.
And that money is held back by a neutral third party, usually for 12 to 24 months. It's basically the buyer's insurance policy. If you, the seller, accidentally breached any of the representations or warranties you made about the business, promises about its health, financials, legal standing, the buyer can claim against that escrow.
Okay, so it protects the buyer from surprises after the deal closes.
Exactly. If no claims pop up, you get that money back eventually. Then there's the net working capital escrow.
Net working capital, that's like the day-to-day operating cash, right?
Precisely. Your current assets, like inventory, receivables, minus current liabilities, like payables, the buyer needs enough cash left in the business to operate smoothly from day one. So an amount, maybe around 10% of an agreed-upon target working capital level, is held back for maybe 2-3 months.
Just to make sure the levels are right post-closing.
Right. It protects the buyer from finding the cash drawer unexpectedly empty, so to speak. And this is where a great M&A advisor really earns their keeping, helping you understand this gap between headline price and net proceeds, modeling it out so there are no nasty surprises.
Bridging that expectation gap, super important. Okay, so you understand the potential value, the deductions. How do you actually present your company to serious buyers? The guide mentions this thing called the Confidential Information Memorandum, or CIM.
Ah, yes, the CIM. Think of it as your company's, flagship marketing document. It's usually pretty hefty, maybe 40 to 50 pages.
Wow.
And it's highly confidential, only shared with buyers who've been vetted and signed a non-disclosure agreement, an NDA.
So it's not just sent out broadly.
Definitely not. This document is where you blend your company's story, its strategy, the market opportunity, and the detailed financials into one compelling narrative.
Why is the CIM so important then? What does it achieve?
It does a lot, actually. It shapes that crucial first impression before they even meet you. It builds credibility, shows you're serious, organized. It helps position your company not just as a business for sale, but as a scarce, valuable opportunity.
Helping justify that premium multiple you want.
Exactly. It connects the numbers to the strategy. And internally, the process of creating it forces you and your advisor to get really aligned on the story, the strengths, and even how to frame any weaknesses proactively. A good CIM signals you're ready to transact.
Makes sense. So you've got this killer document. How do you get it into the right hands? It can't just be blasting emails out, surely.
No, absolutely not. Buyer outreach needs to be smart. It's about intelligent engagement, as the guide puts it, with a carefully selected list of qualified buyers who are actually a good fit.
Okay. Intelligent engagement. What kinds of buyers are usually on that list?
It varies. Could be strategic buyers, maybe competitors, suppliers, customers. Could be private equity firms looking for a platform investment or an add-on to something they already own. Family offices are players now too, or even specialized search funds.
So a mix. And the M&A advisor's role here.
Crucial. They build that custom list based on deep market knowledge. They craft what's called a teaser that's a short, like 1-2 page, anonymous summary to pique interest without giving away who you are initially.
Ah, the blind date approach.
Sort of, yeah. They manage the whole confidentiality process with the NDAs, and importantly, they screen buyers, gauge how serious they really are. This saves you, the founder, a ton of time and stops you from accidentally spilling secrets to someone who isn't a real potential buyer, or worse, a competitor fishing for info.
Right. Protecting confidentiality is key. Okay, so buyers get the teaser, sign an NDA, review the CIM. What's the next big step? Where do they really start to connect with you and the team beyond just the paper? I'm guessing the management presentation.
That's it. This is a really pivotal moment, often underestimated. It's where your company stops being just numbers on a page and becomes, real. It's a story.
Yeah.
Buyers who get to this stage are serious. They've done homework. Now they're forming that crucial, often emotional impression of your leadership, the company culture, the real potential behind the forecasts. They're asking themselves, can I trust these people? Is this growth story believable? Can this business run without the founder totally involved? It's about building conviction.
So it's less about just reciting the CIM and more about that human connection, building trust. How do you nail that presentation?
Be transparent. Look, smart buyers find the bumps eventually. Addressing weaknesses proactively. That builds huge credibility. Be concise, though. Strategic, tailor it a bit depending on whether you're talking to a financial buyer or a strategic one.
Right. Different buyers care about different things.
Exactly. Be incredibly prepared. Maybe bring in key members of your management team. Shows depth, alignment. Just make sure everyone's singing from the same hymn sheet. And if you can, control the setting. Often these happen off-site for confidentiality. It's your chance to show your business isn't just valuable, it's investable. It's got a future.
Okay. Great impression made. Buyers are excited. And then, boom, you get a letter of intent.
Yeah.
The LOI. Feels amazing, right? It's happening. I got an offer. But hang on. Is it that simple? What's a common trap here, especially for lower middle market owners? Something they overlook in the LOI excitement.
You're right. The LOI feels like the summit, but it's really just base camp for the final climb. A huge pitfall is focusing only on the headline price. That number looks great, but once you sign that LOI, you usually grant the buyer exclusivity, meaning you stop talking to anyone else.
Ah, okay. So your leverage shifts dramatically.
Hugely. That's why negotiating all the key terms in the LOI is absolutely critical. The guide really hammers this. Structure matters more than sticker price. Think about, is it $20 million all cash at closing? Or is it $15 million cash, plus maybe a $3 million earnout based on future performance, and maybe $2 million in a seller note? Vastly different deals.
Different risks, different timelines, different tax impacts.
Totally. So in that LOI negotiation, you need to nail down the total structure, cash versus contingent payments like earnouts. You need to fight for reasonable escrow amounts and durations. You negotiate the scope of the recs and warranties, those promises you make about the business. That risk allocation is key.
What else? Things like staying on.
Absolutely. Employment agreements for you or key staff post-sale, the terms of your non-compete agreement, all of that needs to be hammered out because truly, this is the last best time to push. Once that LOI is signed and diligence starts, your negotiating power drops significantly.
Okay, last best time to push.
Yeah.
And then comes due diligence. The guide calls this the steepest part of the entire M&A process. Sounds intense. It mentions founders feeling like their lives are just taken over. That list of 300 plus requests, I can see why.
Yeah, it's like going under a microscope. Due diligence is where the buyer, now with exclusivity, shifts from broad interest to deep, deep verification. It kicks off with this massive information request list.
Yeah, 300 plus items isn't an exaggeration. Financials, legal docs, customer contracts, employee records, IT systems, environmental checks, everything.
Why so intense?
Well, the buyer is taking on significant risk, right? And they've got their own advisors, lawyers, accountants, maybe consultants crawling all over it. They need this info for their own internal approvals, their investment committee, and often for their lenders who are financing the deal.
Okay, so what are the common fears founders have during this? And how do you manage them? Big fear. What if they find something that kills the deal? The answer usually lies in that upfront preparation. Finding and framing issues before diligence often takes the sting out. Proactive is better than reactive here.
Makes sense. And the other fear?
The sheer exhaustion. This is taking over my life. And it can feel that way. But that's precisely where your advisors, especially your M&A advisor acting as quarterback and having a super organized virtual data room, really save the day. They manage the flow, answer many questions, and let you focus as much as possible on running the business.
So relying on the team and the prep work.
Exactly.
And once you survive the diligence gauntlet, it's about making it all legally official.
That's the final stretch. Finalizing all the legal documents. The big one is the purchase agreement, the definitive contract laying out every single term, condition, rep, warranty, everything. Plus tons of accompanying disclosure schedules.
Disclosure schedules.
Yeah, these are detailed lists backing up the representations you made. Think lists of contracts, employee details, assets, liabilities, etc. Then you'll have employment agreements if people are staying on, the escrow agreement, non-compete agreements, maybe a transition services agreement if you're providing support for a period post-closing.
A lot of legal paper.
A lot. And I'll say it again, this is where having an M&A specialist lawyer, not just general counsel, is non-negotiable. Tiny wording changes in these documents can have massive financial or legal consequences down the road.
Duly noted. Okay, we've walked this whole path. But the burning question for many owners must be, how long does this all actually take?
Yeah, good question. The guide suggests a typical full M&A process from deciding to sell right through to closing generally takes about 6 to 10 months.
6 to 10 months. Okay, how does that break down roughly?
Well, you've got about, say, 6-10 weeks for that initial exit readiness prep phase we talked about. Then buyer outreach might be 4-8 weeks. Management presentations and negotiating the LOI, another 4-8 weeks. Due diligence is usually the longest chunk, maybe 7-9 weeks. And then final docs and closing, typically 3-5 weeks.
That's a significant timeline, especially when you're still running things. Can you speed it up without, rushing and making mistakes or leaving money on the table?
You definitely can influence the timeline. The fastest deals aren't rushed, they're just ready.
Ready how?
By doing that prep work before you even go to market, addressing financial gaps, cleaning up contracts, maybe reducing how much the business depends solely on you, assembling that deal team early, getting your data room organized now, not when the requests start flooding, and that alone saves weeks.
So proactivity is speed.
Absolutely. Knowing your story cold, having that strong CIM ready, deciding your non-negotiables up front, it all builds momentum and buyer confidence, which leads to a smoother and often faster process.
Okay. And speaking of readiness, the guide mentioned something intriguing called the premium price test. Sounds important for anyone thinking about an exit.
It really is a powerful concept. Think of the premium price test as like a specialized health check for your business, but viewed through the lens of an M&A transaction.
Okay. An M&A health check. What does it look at?
It digs into critical areas. How clear and defensible are your financials? How strong is your management team beyond just you? How much does the business run without your constant input? What's the quality and diversity of your customer base? Is the business truly scalable?
So it identifies strengths, but also potential weaknesses buyers might flag.
Exactly. But the point isn't to find flaws to scare you. It's to empower you. It shows what's working well, and crucially, it pinpoints gaps or risks before buyers do. It gives you a roadmap to fix things, increase value, and go into the process with much more confidence. Some M&A advisory firms, like the Meliora Group, for example, actually offer this kind of comprehensive test as part of their initial process.
That sounds incredibly valuable, like getting the answers to the test beforehand. Do we have a sense of how this kind of strategic prep, maybe guided by an advisor like Meliora, plays out in the real world, especially for a lower middle market company with maybe some challenges?
Yeah, there's a great case study mentioned involving an East Coast industrial distributor. This company, it was in a tough, low-margin sector, had quite a bit of debt.
Okay, so not an easy sell from the start.
Right. And initially, financial buyers, like private equity, were only offering basically book value, which the seller just couldn't accept. Plus, there was this added complication. Recent commodity price spikes had kind of artificially inflated their recent revenue and EBITDA, making the true sustainable profitability a bit harder to see.
Okay, so a complex situation. What did the advisor do?
Well, the advisor, in this case Meliora Group, didn't just keep banging on the doors of more financial buyers. They took a strategic step back. They shifted the entire focus to identifying a very specific type of strategic buyer, someone who genuinely needed this distributor's unique products and customer access for their own growth plans.
Finding that perfect strategic fit.
Exactly. And that targeted approach, combined with Meliora's expertise in articulating the strategic value, not just the standalone financials, it resulted in an offer that was more than double the highest private equity bid.
Wow. More than double.
Yeah, and they didn't stop there. Meliora also helped structure the deal so the founder had a minimal transition period, helped reshape the org chart for the buyer. Ultimately, the founder transitioned into a consulting role, basically free to enjoy his airplane collection, which was his passion.
That's an amazing result. It really shows the power of smart strategy, expert guidance, and understanding value beyond just the raw numbers, especially in this market segment.
It really does.
And that kind of outcome, that freedom, it leads perfectly into the final piece, life after exit. It's not really an ending, is it? It's a whole new chapter.
Absolutely. And planning for that chapter is just as vital as planning the deal itself. People focus so much on the transaction, but what happens the day after?
Right. What does that planning involve?
Well, obviously the financial side, wealth management, understanding how to make the proceeds last, maybe replacing your operating income with sustainable investment income. But it's also about lifestyle design, purpose. Yeah. Who are you if not the CEO of that company?
That identity shift.
Yeah. Giving yourself permission to maybe pause, reflect, figure out what's next. It could be starting something new, philanthropy, travel, mentoring, and also managing relationships and boundaries. Sudden wealth or even just a big life change can shift dynamics.
Are there common fears around this?
Oh, sure. Things like, will I get bored? Will I ever build something meaningful again? Will people treat me differently now? Totally normal stuff. But addressing it proactively, maybe working with a coach or planner, can make a huge difference because ultimately, the real payoff isn't just the check. It's the freedom, the optionality to design that next chapter with confidence.
So bringing it all together for you, our listener, this deep dive, I think, really shows that selling your business successfully, especially in the lower middle market, it's about way more than just hitting a certain number. It's about strategically setting yourself up to reclaim your time, maybe reduce that day-to-day stress, and unlock whatever that next exciting chapter looks like for you.
Yeah.
Entirely on your terms. The big question is, what does that next chapter look like for you?
That really is the ultimate question, isn't it? The true win is gaining that freedom and choice to shape your future confidently. Whether it's building again, giving back, or just, finally getting to that airplane collection, making sure your next moves really align with what matters most to you.
And just a reminder, this roadmap, these insights we've explored, particularly the focus on the lower middle market and readiness, they're inspired by expert guidance and resources, including the work of M&A advisory firms like the Meliora Group.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.